This is video 2 of our 4-part RM training series on financial statement analysis for supply chain finance. In video 1, we covered the 3 financial statements, that is the income statement, the balance sheet, and the cash flow statement, right? Then we had gone into the different ratios, the matrices like the profitability, liquidity, and the leverage ratios. We had covered what each one of the statement tells, what kind of signals it gives for the supply chain finance, and also to measure the risk involved through the different key ratios. I had also covered a brief about the working capital cycle. Now, in this video, we will go deep into the working capital cycle, how to calculate the cash conversion cycle to understand where the cash is actually logged. All right. So let's now get into the heart of the working capital matrices. So these are the 3 numbers, that is your DIO, days inventory outstanding, your DSO, which is your days sales outstanding, also known as the days receivables outstanding, and the DPO, which is your days payable outstanding. Okay. So what is DIO? Let's talk about DIO, which is your days inventory outstanding. The formula is inventory divided by COGS, that is your cost of goods sold, into 365. Now, what does it measure? What does it tell me? That for how many days is the inventory sitting in the warehouse before it is sold? Okay. So inventory can be in the form of say raw materials or in the form of work in progress or finished goods, okay, or in transit, right? Now, for example, if a company say has an inventory of 30 crore and say a COGS of 200 crore, right? Then what will be my DIO? It will be 30 divided by 200 into 365, right? So it will be roughly around your 55 days of inventory, which is say sitting unsold, right? So what does the signal it gives for SCF? So if a company say has high DIO, which means that the cash is locked up in the inventory, and say the business they have invested in the raw materials or the finished goods, but it has not converted to any sales yet. Okay, so the kind of product that we can suggest to these customers are like your inventory finance or your channel finance, right? And what are the different industries where we can find this DIO, say high DIO? Um so these are majorly in the manufacturing sectors, maybe say in your auto components or the pharma, and it can also be the seasonal businesses. So, for example, if a company is in your rice exports, so they will have very high inventory because they will have to procure rice on the different seasons. Say maybe the kharif for the rabi season, and then they store that in their warehouse, right? Now, but for example, the industries like the FMCG or retail, they will tend to have a lower DIO because they have to turn their inventory quickly. Okay. Also, we can see a trend of the inventory days. So, for example, if a company was having say 40 days of inventory days in say last in the past year, and this year it is having say an inventory days of 65 days. Okay, so the days has increased, so it is actually accumulating the inventory. There is a slowdown in the moving of the stock, okay, or it can be because there is a demand slowdown, or it can be because there are some supply chain issues. So, for example, if no, for the current ongoing West Asia war, many of the say the rice exporters, the agri businesses, or the chemical businesses, the fertilizer businesses, okay, they will now face issue in their inventory because the raw materials they were importing from the West Asian countries. right? For the rice exports, again, they will have more inventory in their warehouse because most of the exports goes to these West Asian countries like UAE and all. Fine. So, the inventory days also gives a credit signal that if it is increasing, then maybe the business is not doing well. It might not just be an SCF signal. So moving to the next matrix, that is your days sales outstanding, or your it can also be called as receivables outstanding. Okay. The formula is trade receivables divided by revenue into 365. Now, what does this matrix measure? That how long after the sale it will take to collect cash from the customer, right? So if I say that my receivables are say around 40 crores on a revenue of say 180 crores, then what will be my days sales outstanding? It will be 40 divided by 180 into 365, which will be coming roughly around say 81 days. Okay. So what does this mean? That the business is waiting for 81 days on an average to receive its cash after it raises an invoice. Okay. As I also said in my previous video that the sales always will not mean that the customer has received cash. Okay. Because once the invoice is raised, it is booked under sales. Fine. So, for example, in this case, the cash is stuck for 81 days. Now, what is the SCF signal it gives me? If there is a high, say, days sales outstanding on the supplier side, say on the supplier's book or on a vendor's balance sheet, the DSO is very high. Then it will be a core use case for trades, right? Because the supplier is starving for cash from its buyers, right? So if it is an MSME supplier who has raised invoice say to a large customer and there's a lot of receivables which is sitting on its books, we can provide trades or invoice discounting to this MSME supplier, right? So trades can be used to provide him an early payment on behalf of the buyer. So then the invoices of the seller is raised on the platform. It will get funded by a financier with the help of the buyer's credit risk. Okay. So any DSO which is above say 60 days will be a strong signal that the MSME supplier will need a discounting facility. Fine. Also, an important factor is to understand the debtor aging. Okay, so what do you mean by aging? Aging is for how many days the uh, receivables is stuck. It can be that the receivables, some of it, the company's receivables is say stuck for 30 days. Maybe some of the receivables are stuck for 90 days, right? So, say the total receivables outstanding is 50 crores. Now, in that 50 crores, say 10 crores is outstanding for 50 days, and say another 10 crores is outstanding for 30 days, and say the rest 30 crores is outstanding for more than 90 days. Okay, then this is an issue because major chunk of the receivables of the customer or of the vendor is outstanding more than 90 days. So this is a red flag because the vendor is not able to collect the cash for a major chunk of its receivable for more than 90 days. That's why you also have to ask for the aging schedule, just not what is the receivable outstanding. Okay. Moving to the next key metrics, which is your DPO, that is the days payable outstanding. So, what is the formula? Again, it will be your trade payables divided by your cost of goods sold into 365. Okay. And what does it measure? It tells me for how many days the company takes to pay its own suppliers. Fine. So if a trade payables of say 50 crores is pending over a COGS, cost of goods sold, of say 200 crores. So what will be my days payable outstanding? It will be 50 divided by 200 into 365. Say about around 91 days. Okay. Which means that the buyer supplier are waiting for 91 days to get paid. Okay. So if it is a large buyer with a strong balance sheet, which means that they are deliberately doing it for their cash management. It's a strategy that they are using the supplier credit as free working capital, right? They're delaying the supplier's payment and not utilizing their working capital for those many days. Otherwise, if they pay the suppliers, then they will require fund for their operations, and for that they have to take the working capital, right? Okay. So this will be a SCF signal from the buyer side. So DSO we saw from the supplier side, DPO will be on the buyer side, right? Okay. So it can be a signal for either a dynamic discounting product or a trades uh, payables, right? So the buyer can actually offer an early payment to the suppliers at a discount, okay, earning a return on their idle cash. So they can utilize their own treasury funds to give a early payment to its suppliers and also earn a discount, okay? Or it can come on the platform and use the trades facilities, the banks, the financiers facilities to pay the suppliers, okay? So any say DPO which is more than 60 days with an say very MSME heavy supplier base will be a strong case for the trends. Okay. And if the DPOs are high with surplus cash and there is very low debt, minimal debt on the buyer's balance sheet, then it can be a case for your dynamic discounting, right? So moving on to the next slide, which is to calculate the cash conversion cycle. Okay. So this is actually putting all the three matrices together. Okay. To find out how many, for how many days the cash is tied up in the operating cycle. Okay. From the moment you pay your supplier for the raw material to the moment you collect cash from the customer. Right. So, what is the formula here? The formula is your DIO plus DSO minus DPO, right? So DIO I said is for how long the inventory sits in the say warehouse. DSO is for how long the receivables take to collect after the sales happens, and DPO is for how many days the supplier credit is used, right? So for example, if I say that my DIO is 55 days, my DSO is 70 days, and DPO is 40 days. So what will be my cash conversion cycle? It will be 55 plus 70 minus 40, which will be your 85 days, right? So for 85 days, the cash is tied up. Okay. So if any number which is greater than 90 days, so if my cash is say stuck for 90 days, then the company has high need for working capital borrowing. Okay. So you can pitch the entire SCF program to the company, say both on their supplier side and the buyer side. Okay. So you can pitch them trades for payables as well as factoring for their receivables. Okay. Now, anything between say 60 to 90 is a moderate stress. The CCC, if your cash conversion cycle is between 60 to 90, that will be a moderate stress. So you can either see wherever the stress is, it can be maybe the inventory days are very high, or the receivable days are very high, or they are not extending their DPOs. So basis where the stress is, you can pitch the suitable product. Okay. Now, if the CCC is between say 30 and 60 days, then they are like kind of managing their working capital. Okay. And if the CCC is say below 30 days, or if it is negative, then they have a lean working capital cycle. Okay. Because business is collecting faster than they are paying to the vendors. And this you can see very common in your retail or FMCG companies. Okay, where it's a very strong buyer. They have more power to delay their vendors' payments and also collect the cash from their, say, distributors or dealers. Right? Now, in these cases, you will see that they have high cash in on their balance sheet, and that is where dynamic discounting will be the best fit. Okay. So video 2 is done. So till now we had covered about the different financial statements, the profitability ratios, the balance sheet ratios, and then we also covered the working capital matrices, the cash conversion cycle. Now, so the key takeaway is that uh, if my CCC is higher, is bigger, then the cash is locked up, and it's a bigger opportunity for the supply chain finance products, right? So in the next video, in video 3, we will map each one of the trades product with these gaps, and that is where the analysis will come into action. Thank you.